Hi guys, Hugh Hendry, ex-Global Micro hedge fund manager. And I wanted to share a few words with you before we dive into my great, fascinating conversation with Tom Roderick. It was a matter of explanation because I recorded this in the room that I'm using in the building site in St Barts. I am presently building a beautiful 6-bedroom new villa on the island. But I have decided to live in this kind of squat-like condition. It's hot, it's noisy, it doesn't look very charming. And my point to you, or the metaphor that I wish to extend is, it's the future. That's what the future looks like. It's uncomfortable. People, this video is uncomfortable. My lifestyle is uncomfortable. The way I dress is uncomfortable. I am not doing it out of disrespect. I am doing it to demonstrate the point that the future can be ugly. So anyway, now that you're forewarned, let's dive in and hear what the wonderful Tom and I can come up with. Thank you.
Hey, I'm with you. I'm with Tom Roderick. Tom is the real deal. Tom is actually engaged in the management of risk and being curious and seeking out opportunities in this fascinating world, especially fascinating as we approach the end of 2021. And the idea really, it's not even a pivot, is this is punk rock, but I kind of want to do freestyle and like discuss the issues which are in our heads and what I'm thinking remotely on an island and in what you're doing, Tom, in London. So let's see, give us a chance, folks, and let's see if we can do the scatology of markets at the end of 2021.
Sounds good to me, Hugh. Well, I've got my new microphone here, so hopefully that'll help a little bit. But I know that you're not convinced. I'm sure there'll be naysayers, but let's give it a good go.
No, you're definitely sounding good. And again, we were talking, I think, last week and whatever. And so what does it mean the end of 2021? To me, it means this incessant noise. Inflation is this kind of really weird thing because it supposedly, or like events in nature, phenomena in nature, we can touch, we can see, we can hear. And for inflation, all of that is represented in the fact that you have higher prices. And so it feels you don't need a degree in economics to kind of call it out. And people are calling out the fact that we have higher prices today. And you can't lift a financial newspaper or any newspaper without people saying, hey, it's inflation. And the weird thing is there's therefore this great kind of call to arms. Hey, this is bad. It's remarkable how actually society, our culture, really embraces it as a threat. It's like, we got to stop this out. This is really bad. And then there's kind of no joined up thinking. Is it bad? Is it actually inflation? Have you been misinformed? Are you really feeling pressure from this? I think yes. Do you really want me to raise your mortgage? Is that what you're asking me to do? So that's kind of how I see the drama or lack of as we sit here today.
Yeah, I think, well, it is inflation in the sense that prices are going up. And, the reason behind why those prices are going up, you can have many arguments about. We just saw what was it, I think it was a 10-year record in US CPI at 6.2% earlier this week, which kind of freaked some people out. Not really sure there's a huge difference between 6.2% and the 5.9% that was expected. We've clearly got a transitory supply shock. You either think that there is that is the case, or you think that's not the case. And a few kind of tenths of a percentage point here or there, I don't think really changes your argument either way. You have seen inflation expectations go up as well, like in the market tradable, US break-even swaps and in the US tips.
I haven't seen that chart. I am aware of the fact that bond markets, international risk markets, kind of played with the emergence of this inflation thing. So like here we are, and the latest CPI read is 6%. But kind of a year ago, bond markets were repricing, US 10-year treasuries lifting from lows of 45 basis points and kind of just below 180. I think initially they flared and peaked out about 165, 170, but that was February of this year. And I'd have thought the inflation expectations would have been an integral part of that move. But really my question is, what has happened since the end of February this year with the inflation expectations? Have they continued to move or
low? So essentially inflation expectations at the long end and at the short end have continued to move higher. Now, given the continued inflation shocks that we've seen in CPI data, and obviously that has a knock-on effect on, let's say, inflation expectations 1 year, 2 years out. And so that's kind of remained high. But as that's remained high, you've started to see back-end inflation push higher as well. So since, so I think US 10-year is sitting at about 1.57% at the moment. As you said, the highs are something like 165, 170. So we've basically been flat since February in nominal 10 years. But in that time, you've seen break-evens go from something like 2% to 2.71%, which, so your instinct would have been that, if you'd have known what had happened to break-evens over that time, you'd have guessed that the 10-year would have gone up alongside it. Actually, that hasn't happened. Instead, the 10-year has basically stayed where it is. And, as a result, the remaining part, which is real interest rates, have come down markedly over that period of time. So I think, we're now sitting at about minus 1.2% on 10-year, which means that, if you take the market implied 10-year expected inflation and you take the current bond yield, investors who buy 10-year bonds can be expected to lose approximately 1.2% a year every year in real terms over the next 10 years. So you're basically locking in a big loss over that period, or at least that's what the market tells us. This is not based on survey data. This is all based on like tradable instruments.
But I thought, just as we have curves with regard to like duration and bond yields, and you get steepeners and you get flatteners, and this we've had a bit of everything this year. But I thought the 5-year was higher than the 10-year in terms of the inflation expectations. So the market's kind of going, we see this thing flaring, but as you move out on the curve of time, actually the inflation expectations kind of drop off, and quite severely after 5 years.
That is still the case. So the curve is inverted across basically all time periods in inflation expectations, or if you're a commodity guy, you'd call that backwardation. So the front end is really high, the kind of the middle of the curve is a bit lower, and the back end of the curve is even lower again in terms of inflation expectations. So what you've seen over the course of the year is, in February, there was backwardation in curves. The inflation curve was inverted. Since then, the front end of the curve has gone up a lot, and the back end of the curve has kind of got dragged, kicking and streaming alongside it.
Yeah.
The shape is the same, but it's curious in a way, because if you just looked at the bond market and you looked at the rate hikes that have been priced into the curve in the very short term, if you look at 2-year US yields, or you look at 5-year, we've seen that come up significantly. Whereas, if you look at 30-year yields, they essentially have gone nowhere. I think at one point they were down year to date. If you just look at the nominal interest rate data, that would suggest that people are looking and thinking the inflation we're seeing today is purely transitory. But actually, if you look at the inflation break-evens, they tell a slightly different story. They say that it's kind of transitory in the sense that it's expected to go down over the short to medium term, but it's still, it seems every month the amount of long-term inflation that people expect does kind of creep higher, which I guess makes sense, because most of the people who are sort of talking about transitory inflation have been wrong in their predictions that inflation was going to come down markedly by now. It just, we haven't seen it happen.
We've got different takes on this. I uncomfortably find myself in the chill out, relax, in the kind of the central bank camp, and this overused transitory word, and why? Because we live in such a screwed up world. We shut everything down. Everything globally was shut down. Stay at home. We closed factories, we closed mines, we closed ports, we closed everything. And you close people's minds, you close behavior. And then it's like, hey, no, I changed my mind. Wake up, no, go back down to that mine. You open that factory, put the lights on, and here we are. And so only a year, not even a year since we fully ramped up and it's only since, I want to say, am I right in saying it's only since July the UK reopens? What am I talking about? A year? Not even a year that we actually started the resemblance of some normality. I don't know why anyone would be expecting that the transitory phenomenon would have been out of the system by now. It's for sure it's another year or so, but it's never on this planet have we taken the entire population and said, run, danger, stay at home, don't come to the office, don't come to the factory. And then you give them the opposite, and sure, prices are higher. And that's why I'm just mystified by am I mystified? Clearly, well, that's why I find myself in this uncomfortable gang of central bankers, whereas you're in the cool gang.
I'm not sure if it's the cool gang, but you are right though that it's the crisis is not over in the sense that things have really only just started to fully open up. So I think the US land border only opened to foreigners at the start of this month. And you've still seen, if you look at foreign air travel, especially transatlantic long distance, that's all still closed. No one can go to China. It's very difficult to travel to Asia. You might be able to travel around Europe and within the US quite easily, but you go. I think now as a UK citizen, you're allowed to go to the US without too much trouble. But that's a pretty new thing. And so you're right. There's a lot of transitory factors that are still there, and I think sometimes when you look at global supply versus global demand of any particular good, it's very easy to say, oh, well, there's enough supply, and so we shouldn't be seeing inflation in these prices. But what you've seen is, especially the US has seen absolutely gangbusters demand, particularly for goods, whereas a lot of Asia, which is still shut down, and Europe, which is sort of in between, has been a bit slower.
We just closed everything. Everything is on its knees. We're trying to kind of reconfigure. We're trying to work out the code to get into the factory. Oh, and the US just gave everyone like a couple $1,000 to buy stuff.
Yeah, the money's got to go somewhere, right? But I still think that under the hood, there is a deeper build in inflation that's come in, which is premised on a couple of different things. One of which is that governments just don't care about austerity anymore. You look at governments both left and right, that they want to spend money, and that's even true in Germany. In one of the most frugal places, you're seeing Italy and Spain being allowed to carry out vast stimulus programs, as well as the US. There's just been a change in the mentality of the political class towards spending and the dangers of spending. Which is understandable, because all of these people who are harping on about government, high amounts of government debt are going to break the system, have been proved to be completely wrong. And so whatever the amount of government debt that causes the problem, it's a lot higher than it is now.
That's tentative. The Germany domestically is still got the handbrake fiscal neutrality rule. They can't, they have to run balanced budgets. The UK is just a circus just now. But on the one hand, the ruling Conservative government is kind of changing its spots and kind of seeking to spend. But at the other side, taxes are going to be at the highest level since just after the tax take from the economy is going to be at the highest level since just after the Second World War back in the late 40s, early 50s. And the governing class really has the willies about being associated with 80% debt to GDP. And then if spending money and taking debt to GDP, and I agree, I think UK could take debt to GDP to like, it could double, and I don't think it would have that much significance. Japan has more than done that. Mm-hmm. And if fiscal largesse were the silver bullet that killed deflation, then Japan would be showing us the way, and it's not. And it's odd that it's not, and it seems to be the thing about, is it MMT? This kind of new theory of, again, like, hey, deficits don't matter. But the kind of pushback against that is there's just something very subtle with capitalism and with private risk-taking entities, and they just kind of don't get it when governments are doing the spending and it's not private sector, profit-motivated private sector agents that seem to be doing the spending. That's kind of my only take on why Japan could go from 60% debt to public debt to GDP to, I think, 260% debt to GDP in the space of 20 years and have nothing to show for it. The private sector went, and so I don't know. So I hear.
Well, I guess the question is, what would have happened had the government have not done that? Maybe the private sector would have done more. Maybe we'd be in a deep depression. It's difficult to say. But one thing that I do think that we can probably both agree on is that, if you look across the economic cycle from boom to bust, the bust response has changed across the world. Because this, in 2020, when we had a bust, like, central bankers were just like, blam, let's just hit this thing. And, as a result, we come out of it with inflation. And so, usually the most risky point of the economic cycle when it comes to inflation versus deflation is in the bust, when you have a risk of outright deflation. Now, I think that part of the cycle in terms of inflation has been capped. And so what we don't know is whether the normal sort of like, mild boom type economic period, whether the governing behavior has changed in that period. But we certainly know that there is an inflationary stabilizer which is much more powerful than it was before. So I would have thought, over the next couple of economic cycles, even if we just see the same aggressive response in the downturn, the inflationary dynamic has shifted somewhat because the deflationary tail is gone.
Reaction function. We don't know the effect of the reaction function, I think, because of the immense noise of the global closure of the entire system. So, whatever they had done, just reopening the thing was going to kind of be would have friction. Would have an effect on prices. But I hear you. My thing is that it's the monetary side. It's the monetary side, and it's the cultural, psychological side of things. Monetary in that we have to go back, and again, this is incredible. We have to go back 50 years. So like when I was starting off my career, 50 years ago would take you to the 1920s and the early 1930s and the Great Depression, and that just seemed like history books. We may as well have had like Tudor kings and people dressed differently, and there were no phones and cars were weird, and like 50 years is a long time ago. Yeah. 50 years, of course, today is the 70s, and the inflation then. What was, to my mind, what was happening, unbeknownst to everyone else, was the euro-dollar system. This ability to create dollars offshore, unregulated by the dollar bank, the Federal Reserve, just had this immense, like someone dropped this huge boulder into this pond, this overseas pond, and it was the oil prices, all these surplus reserves created by, I don't mean it to be rude, but like Bedouin tented communities in the desert suddenly being host to billions, if not modern day trillions of dollars, and putting it into this system and say, hey, lend money. And so you had immense and kind of almost invisible in terms of, it wasn't invisible in terms of its impact. Its impact was on pricing. And you could argue there were some supply shocks, namely the embargo with regard to the oil. But so I want to say shocks. So COVID and closure of the global manufacturing, global of everything, embargo 50 years ago. But to create the inflation, you need this monetary response from risk-taking commercial banks. You had that in the 70s. You have just not had that today. So with banks, they are desperate to own more and more treasuries. They are desperate for the shortest duration treasury bills. They are desperate for collateral that has zero assumed risk. That's not inflation.
Well, yeah, and I do think that is a big problem because, as I think in the 70s, and global wealth to global GDP was like 2x. Now it's like 7x, 8x. And so, relative to output, there is just so much more assets out there. And so there is little reason for the banking system to seek uncollateralized loans. Like there's just a shit ton of collateral. Like if you don't have any collateral, why would they bother? There's just so much there's just so much collateralized lending to fight for. There's no.
There's so much. It's a kind of weird thing because there's so much, and yet there's a scarcity of the right stuff. And like the stock market is the representation of that. You have 5 US tech stocks, which their capitalization is greater than the capitalization of Japan, or as the capitalization is about 90% of Europe plus the UK. Like collateral in terms of risk, businesses deemed to be riskless. Government US Treasury bills. Remember, there was a scarcity created this year by the US shutdown, where the US Treasury could issue these short-term bills, and the banks going, but we need these. We don't want to put it into other forms of collateral. So there's a kind of pyramid of collateral, and there's a scarcity at the top. But sorry, I hope I haven't broken your train of thought.
No, not at all. Yeah, well, there's a scarcity of collateral in some places for sure. I guess in terms of treasury paper, there's a scarcity. In terms of housing, in terms of other types of infrastructure, in terms of brand value, all of these things, which you can basically raise money on the back of. There is no shortage. Like if you wanna find an asset to borrow against at commercial rates, there isn't an issue. If you're a bank and you wanna, there maybe is a shortage of safe assets, of like truly safe assets.
To lend money, Tom, I don't think what you're saying is accurate. I think you're mixing a few things. Maybe I'm mixing my brain. So I could go to a wealth management. I could go to UBS, Credit Suisse, Goldman Sachs, to name but a few, Morgan Stanley, and they could say, hey, we'll give you this facility. Hey, you've got this. You're the CEO of this company. You've got like you're Elon Musk. You've 20%. It's worth $200 billion. And basically, it's kind of like, it's not a slush fund, but it's like, we've got that collateral, and you can we'll lend you credit, but it's like not a mortgage. So like I had hedge fund holdings, but it's like, well, we'll give you the same as the money you've got on account with us. But that I'm looking for a mortgage, or I'm looking for a loan where I give you equity of 10% and you give me the other 90. And those kind of wealth management deals where you pledge your stock, you could pledge any kind of stock, and then you kind of get a line of credit, but you don't get a leveraged line of credit. That's what I'm trying to say.
So what are you saying? Are you saying that something has changed, or are you saying?
No, I'm saying it again. The Jeff Snyder kind of example, which I'd encourage everyone. I think is episode 62 in the euro dollar thing. Just the way the world works. A manufacturer in Singapore. Singapore has Singapore dollar, which is like it's the Swiss franc of Asia. It's an amazingly formidable, strong. It's deemed to be a store of value. But the manufacturer is working in the global dollar-based system, and it needs dollars. And the Singapore bank doesn't have dollars, and it wants to make this loan. And to make the loan, it has to go into the money markets, and it needs collateral. And it needs dollar collateral, and it needs to borrow someone's dollar treasury bills, and it has to layers of protection and all that stuff. And you discover. And it kind of takes us back. One of the pressing issues in my head that I'm watching is the movement in the US dollar, which is going higher. And I am attributing some of that. It seems to be gaining a degree of its movements short term just now are confounding a lot of people. And to my mind, seem to kind of resonate with the notion that there's a lack of dollar collateral. And so those kind of loans that the manufacturer in Singapore would like to do to facilitate what the orders he's received from the US are kind of not happening. And that's manifesting itself in the dollar. I also think that collateral and that dollar move has got something to do with under the surface, the plumbing in China. And again, the collateral issues where Chinese property has gone from being what's deemed to be a no-brainer, very low risk, and yeah, you can use it as collateral, to being the last thing we want to touch. But I think that's many iterations away from where we are presently. So we've got 6% inflation, the highest kind of year-over-year prints in 10 or 15 years. The Bank of England had almost raised interest rates. There's an absolute accepted wisdom that rates will go up next year, albeit like baby steps. Maybe the Fed gets to 225 basis point hikes. One could go big deal. And yet the bond market's going, guys, just don't touch the system, because there seems to be like the people who actually see this, the euro dollar, this dollar collateral lending credit system is invisible. We don't see it. No one's reporting figures on it. You only see it's like this phantom. And something touches you, or something blows your ear. You're like, what was that? That was the euro dollar system. And that's why we look at movements in the dollar, and when they seem to be odd, we look at flattening or steepening in curves. We're just looking for the presence. And smart capital markets are still kind of saying to me, ooh, I feel uneasy. I really feel uneasy about this, about where we are. But
the problem is with the offshore dollar system is that, simply because it's very hard to get like good data on it, you can basically make whatever argument you want and use it to explain anything. And, you can never prove, whether you're right or wrong. And you can basically say, oh, I wasn't wrong because inflation was coming. I was wrong because actually the euro dollar system was coming back to life and I didn't see it. You can use it to explain everything. And it's just like, to me, it just seems like this giant catch-all sort of bubble that you can use to tie any view that you have to the mast, and it remains unchallenged because no one's ever going to know.
Okay, yeah, no, that's fair enough. But and that's this kind of the dangers of causality. I could be linking it to UFO sightings, and
but who's to say the euro dollar system doesn't suddenly spring to life? And, euro dollar lending is suddenly up massively next year like it's never been seen before. Like,
well, indeed. Is to say that. But, my predilection for it is that it kind of rationally kind of seems so like, to my mind, business cycles need a change of behavior. You need people to kind of go, the risk providers to kind of chill out and go, we survived, first of all. And then it's like, hey, not only we survived, but wake up, guys. We've got to start making money again. We make money by taking risks. So there's a cycle of emotion, right? And that cycle of emotion expands liquidity and contracts liquidity. And that creates these business cycles. People get jobs and they lose jobs. They have more money in which they can spend, or the inverse. Looking at the banks, you don't see any of that, right? Because they are not lending. I mean, or they're lending, but their growth rates are remarkably alarming if you're trying to gauge economic vitality. So there has to be something else. And so the thing is, below the bonnet, banks actually prefer to do it all offshore in these kind of invisible, swamps of liquidity. And what happens is, like, it's like, the Modena drug is hyper efficient. We've got a solution. We've survived. It's now time to start taking more risk. What that means initially is start taking any old collateral. Like, give me Tesla stock. Great, fantastic. I'm happy with that. And I think we saw a cycle. We saw a cycle in the stock market. It doubled. We saw a cycle in Treasury bond yields. They went from 40 basis points at the 10-year to 160. And that takes us to February of this year. And then they didn't. Kick data. They're trying to put this immensely complicated jigsaw puzzle together. But the Fed kind of gives you all of this data. It holds the treasury bills for all these central banks around the world. And it kind of tells you what's happening. And a rare thing has been happening. They have been at the margin over the height of summer selling treasuries, not because they've got an inflation thing. It's the last thing they want to do. If they're selling treasuries, ding a ding in my head, their domestic system is creating, their banks are saying, we don't have enough dollars to run this collateralized lending system. We're having to turn away credit, which is going to threaten your GDP forecasts. So you kind of got to do something. What do? They've got to go and do the last thing they want to do, which is sell US Treasury. It happens very rarely, and it's happened this year. So yes, I may as well be talking about UFO sightings, but it kind of has the threads. We have to invent something because the optical banking system is not revealing itself.
Well, I think it's no surprise that it's not revealing itself. Like, I don't see why it would ever go back to the way it was in the 70s. It's just that, like, the system is just not aligned that way. There's too many assets, and so I just don't see how you would incentivize a rational bank to not do asset-backed lending and to do other lending instead. I just don't think it's going to happen. And you look over the course of 2020, and people got excess savings. There's a buildup of excess savings. There was an attempt to use those excess savings to spend on goods, because that was, because a lot of services in the form of, tourism and restaurants and stuff weren't available. So spending on goods increased. And as a result, goods inflation increased. But there was still excess saving, and there was still debt that was paid down as a result. And so there's more cash in the system. Like, so, as on an individual level, there's unlikely to be that much need for that additional bank lending. Like, I don't really see from an economic perspective why we need more lending. And I think that there is something else that's going on here, which is one of the reasons why I think that we're seeing more inflation. And that is basically more marginal money going to the poorest members of society who have a hugely higher propensity to spend it. A lot of these Biden cash distribution programs went to poor people who just immediately spent it. Whereas QE, basically, you just line the pockets of investment banks. You've got no idea what to do with it. And so it just ends up sitting back at the Federal Reserve again, and no one leverages it. Whereas if you actually get spending up by people who don't have very much income, that circulates through the system very, very quickly compared to the other type. And so I actually think that, over a 5 to 10 year period, you could see an increase in inflation due to the continuation of those types of policies, whereby there's essentially a transfer of wealth away from very wealthy to less wealthy people. And with that, and you don't necessarily need any increase in bank lending. You just need an increase in wages and an increase in transfer payments from the government. If that happens, I think you will see a period a period of sustained inflation as a result of that. And yes, that to some extent is not something which can last forever, because let's say your Gini coefficient, or however you want to measure wealth inequality or income inequality, can reduce and then it can go back up. So it's not like a sort of like an accelerated process, but it is still something which could see meaningfully higher inflation as time goes on.
In America, it's the same. The Democrats, who are deemed to be big government guys, but they were supposed to be having a $3.5 trillion fiscal expansion, and it's not. I think it's been brought down to like $1.5 trillion by the Democrats. Going, Jesus, guys, I'm not comfortable with this. And these benefit in kind checks that we've sent out to the poor folk. I don't see another one of them coming. And before I see another one of them coming, I see Biden absolutely becoming terrified about 6% inflation, probably firing Powell, doing all these stupid things, because it's like, our popularity is collapsing because of the inflation. You got to solve the inflation. And we're going to create we're going to throw dirt and grime and stones into the system of economic commerce. The thing's going to get clogged up. It's going to stop and it's going to fall over. It's either going to be interest rates or it's going to be private sector agents going, and like your point, you don't think the system needs lending just now. Let me tell you why I think the system does need lending to collaborate and confirm the continuation of economic growth into next year, and an economic growth which allows us to take out the deficit created by the downturn in 2020 and not making that a permanent loss of capital. What has to happen, and what hasn't happened since the great financial crisis of 2008, is whatever economic response from the government and whatever economic recovery that it's created, which has been muted, there's been no one in the financial sector going, wow, yeah, I really now see an opportunity for me to expand. I want to lean into this. I want to open new stores, or do a website thing. I need a factory. I need money. I'm going to the bank, and in going to the bank and getting that loan, fractional monetary system, money is created. A lot of money is created because you had a private sector agent who became a bullion. He became positive and optimistic about his position in the economy, such that he wanted loans. When they're not doing that. So the labor shortages is the same thing. So to my mind, not hiring truck drivers or, the whole spectrum of people that are not being hired just now is a function of enterprises going, do I really want to start locking in a 40%, 50% increase in my wage bill when my best guess is this thing's going to roll over again? So economic activity is going to fall on its fanny, and I'm going to be left with a legacy where I'm paying these guys and girls 40, 50% more. So I don't believe, to my mind, I'm saying to you, there's not enough people who believe in the potency of what we're seeing now and its continuation to make it real.
Well, demand has not stopped, right? Consumer demand for all sorts of things has continued to be high. And so far, the sentiment is turning a bit, but there's been no sign that people are getting put off by higher prices. That hasn't happened yet. And that hasn't happened because there was a big buildup of savings last year. So people kind of feel like they can afford it. If they can afford it and they're willing to pay higher prices, eventually, let's say you're a trucking company, the amount that you can make for every truck driver is going to go up, and so you're going to eventually start paying those guys. Maybe you'll initially try and take them on short-term contracts. When you do that, what's going to happen? Someone else will poach your staff. Eventually, you're just going to have to pay the guy. And we could have had this conversation 6 months ago, and I think it would have been more valid 6 months ago when it did seem like we were just due a very temporary spike in inflation. As time goes on, that behavior will change. The longer we see inflation being sticky and high, the more likely it is that businesses are going to see that they are missing out on immediate revenue, and they're also going to think, well, maybe this inflation isn't going to go away, and maybe we are just, we are losing competition, we are losing orders to our competition because we're not taking it. So we're basically, you've got our competitors are growing, we're not. Why are we not growing? Because we're refusing to pay wages.
But all of that then rests on it rests on momentum in economic expansion being maintained. Hire the truck driver into the additional kitchen help and the service and stuff. It's the big debate is okay, it's great now, but are we robbing the future for now? And until that's finally resolved, I think that's the thing that's going to kind of hold things in abeyance. And then I also because I said to you, so inflation is this monetary phenomenon, but to my mind, the most breathtaking aspect of it is cultural. In that, again, so I think culturally and psychologically, what is amazing about now is again just how alarmed ordinary folk and non-financial newspapers are about inflation. It's just like it's like, oh, it's really the bogeyman. It's the scary thing, and it's like we got to do anything to eradicate it. There seems to be an immense consensus in popular opinion that this is a bad thing, and newspapers reflect popular opinion. So on their front pages, they're like, "This is great. We need fear." COVID was amazing for newspapers, for TV channels, because it was the distillation of fear. People love being terrified. Now we've got less COVID. Now we've got inflation. Fantastic. And
I don't see any of that in the UK. I don't see any groups who are pushing to put rate hikes through the system as a result of any of this.
I read digitally the front pages of all the major white page highbrow papers, and there's not a week goes by without kind of warmongering about, mortgages are going up, that the end of cheap money is over. Blah, blah, blah.
Yeah, but no one is, I agree that people are like complaining about inflation, but no one is pushing to do anything about it. Whereas I think that's the difference.
I disagree with that. I mean, I think they're desperate to stick the knife in to the Bank of England. Oh, you're failing your mandate. You've got a 2% mandate. I know it's there. What are you doing about it?
Well, I don't see the Conservative Party doing that. I don't see the Labour Party doing that. I don't see like front pages criticizing Bailey for not hiking rates. And I'm sure you agree. You think that this inflation is transitory. You surely agree that it would be a mistake to raise interest rates right now.
Yeah, I do. But I have to say, you are the author of a brilliant statement this week. People, because it's always better to say, but what would you do? And like your solution, I thought was breathtakingly good in terms of the Fed should say to the markets, and it's never going to happen because it's too truthful. But it's like, we have such a bad record of forecasting the future, especially when it comes to anything to do with capital markets and money. I know we are meant to be the purveyors of money, but we're really nice. We're really diligent. We work really hard. We've got academic degrees. We love people. We're nice people. We're nice to pets, but we can't predict interest rates. So what we're suggesting, a break with tradition, we are not going to raise rates until the 10-year Treasury exceeds 2%. I think that's fantastic.
Yeah, I think it would probably work. It would probably solve it. It would probably make decision making a lot easier. It's probably never going to happen.
It's not going to happen because the Fed has invested an immense amount in the propaganda that actually is the opposite of all of that, that it is the purveyor of the truth. It is the light that sees the future. It is the beacon of stability. It is the solution. And so it can't reveal its ineptitude. And again, it's not, that sounds damning, but how on earth would like a collection of people meeting on a regular basis, how would they get it better than thousands, hundreds of thousands of people, like tiny little decisions all the time, and then being able to distill all of that? How would one be better than the other? And yet, their system is predicated on.
The way that I see it in terms of rate hike decisions right now, okay, let's just be very binary about it and say we've either got transitory inflation or it's going to stick around here for ages and ages. If it's transitory, hiking 25 basis points, 50 basis points could be damaging to the economic recovery, which actually under the hood is not that healthy. If inflation is permanent, 25 to 50 basis points here and there is going to make absolutely no difference to 6% inflation. Either you basically hike rates to 6% or don't bother. Like there shouldn't be an in between. Like it's just in between is absolutely certainly a bad idea. You're not going to solve anything. If it's completely transitory, you shouldn't do it. If it isn't completely transitory, you need to go way more than that. And so, clearly Western central bankers are not willing to put rates to the kind of levels which would actually tame this level of inflation if it was sustainable. And so they should just wait. Just wait and see.
And let's take that advice. Let's actually, so the Fed should raise rates when 10-year treasuries go above 2%, and we should actually vow never to discuss inflation or its opposite, inflation really, until US treasuries exceed 2%. Because, like you say just now, like this has been entertaining, but a kind of pointless conversation because the large part of the credit market, the belly of the US Treasury market is like, that ain't inflation. Move on. And yet we just spent an hour going, oh, you think there's inflation? I'm like, I don't think there's inflation. Like, shut up, guys. Like the bond market just was like, yeah, we're watching it. There's nothing. We'll let you know. We'll push rates above 2 if there's a problem. Now, again, I think it won't get there because these episodes where we get this cultural terror of inflation, the Venezuela, the South American economies, you've got to go back 100 years to go into proper proper functioning social democracies to actually get these immense levels of inflation 100 years ago. And the difference between then and now, you said it. You said wealth has gone up. Did you say 7 or 8 times, which doesn't get recorded when people are looking at these gross debt to GDP statistics? That's a stock versus a flow thing, and then they don't look at the other stock, which is the wealth component. But we have to establish, have we built cultural fire breaks, like a forest with these fire breaks? Have we built a profoundly powerful fire break which will prevent and deny the ability of elected politicians to create inflation? And the fire break is the sheer magnitude and scale and size of the stock of debt versus the flow of GDP income. Whereby if you were to reprice the stock thing, which is 4 or 5 times the flow, the consequences on the flow would be pretty dramatic and would snuff out the inflation. That's a hypothetical question. I don't have an answer to that.
Well, if you look at Europe, right, like 5-year inflation in Europe has gone from 0.5% to 2% over the last 18 months. Bunds are still negative. So, the market is basically telling you that you can have quite a lot of inflation and nominal yields are still not going to go anywhere.
Yeah. So if I was managing a hedge fund, I'd be like, God, why is this so dumb, boring? Like, people shut up. Like, okay, how do we tell me something interesting. What's happening in markets? And what's happening in markets just now? Again, the Financial Times and the other supposed experts got it wrong. They're talking about how real rates, you got to go back to the 1970s to find real rates as low as they are today. And they're just talking about short-term real rates, which are meaningless. It's the long-term rates. You've never had negative, 1.2, 130, 140 basis points of negative real yields at 10-year duration. You never got that in the 70s. And gold had this grotesquely gold-like pullback. It's been awful. Gold is so damn awful, but it's based and is beginning to get a bit of action. So obviously real yields, gold. Do you want to explain that actually? Why are real yields and gold, it would seem, the principal component in factor analysis for explaining subsequent gold movements?
I I don't know if I want to explain why that's the case, but it certainly.
I wouldn't like people to think we just make this up, and we do know
appears
what
to
we're
be the
talking about.
case. You know, if you look over the last like 5 years, and you plot US like 10-year real yields versus the gold price, you need to invert one or the other. It has an extremely tight relationship. That relationship actually started to break down a little bit in the second half of last year. And my answer to that was when crypto became relevant in terms of its magnitude relative to gold. And so it turns out that if instead of just using the gold price, you basically you take your market cap of gold, you add it to the market cap of crypto, and divide by the gold price. And divide by the amount of gold. Basically, before 2020, it just looked like the gold price. And since then, those two things have deviated as crypto market cap has gone from, I don't know, essentially a couple of $100 million of market cap to 2.5, and I think it's now even be $3 trillion. That all I'm saying is an observation, and maybe we can bring up that chart, that real yields and gold plus crypto is the new relationship. So crypto somewhat seems to be acting in the same manner as gold used to. It makes sense to a certain extent because, gold is something which has which over a long period of time keeps pace with inflation. And so you can argue that means it's got a real rate of 0. It just keeps track. If inflation goes up, gold goes up. And so if you've got a negative real yield on dollars, that, relatively speaking, you have a positive yield on gold because you don't have to pay anything to get the inflation protecting ability of gold. Whereas in government bonds, you now have to actually pay to get that protection. And so as a result, gold looks more favorable.
That's nicely put. Nicely put. There's a, for another time again, but like in terms of my reading this week, Michael Pettis just repeated what he writes for as long as I've known him. He's a genius. I love him. But this time, the particular configuration of his words, I was like, God, I really get it. But I'm sitting going, can I actually recount what I really get? And I can, except, and I'll come back on Twitter on that, but except the tagline, which is that as long as, surplus saving nations, China, Japan, Germany, Europe, Singapore, etc., maintain this model where their domestic, where working there, you never fully capture the productivity of your endeavors. You're kind of underpaid. It pushes immense pressure on unskilled labor in the deficit countries, and it requires an infinite rise in debt to GDP in those countries, and it keeps a floor on wages. And by keeping a floor on that factor of production, it means that it just keeps pushing profits to infinity higher. And so it's the system is actually, it may be disagreeable, but it's very rational. And if anyone is looking for solutions, the solutions again are not to be found, and it's unfair to blame it on the Fed and other central banks. Actually, the solution is right there in front of you. And it is the organization of surplus economic countries.
I was just seeing if I could find that thread to kind of just tell you what he said. But yeah, I think you basically put it quite well. It's just, China grew its exports, it grew its productivity, which is to be expected, and it repressed its wages such that it wasn't buying as much as you would have expected of everyone else's stuff. And so and at the same time, it repressed the level of its currency, and so basically remained competitive and didn't allow itself to rebalance.
And it's subtle, and some people don't get it, because we're not saying wages haven't risen in China. They've risen a lot. They've risen really, really fast. But the productivity from moving someone basically with a peasant ability to work a paddy field to working in a high-tech factory was so enormous that they never fully got it. Or if they got it in a kind of nominal sense, they didn't get it by the management of the exchange rate, which didn't allow the currency to appreciate and make them richer vis-a-vis the rest of the world. And then get China it would be better now if China was not running current account surpluses. The world would be a better place if it wasn't running surpluses, if it was balanced, if it was having a massive consumer boom, and until we see that, these markets are going to continue. Now, and hey, it's punk rock. And I'd like, again, just to explain, yes, normally I am a bit slovenly in my tropical island attire, etc. But I'm really off the charts because I've been cut off the water grid network for 2 weeks. So they tell me that it's coming back today. I hope so. I've got a garden hose fixed to the outside wall, so I will be scrubbing away later on this afternoon, I hope. And Tom, thank you very much.
Thanks a lot, Hugh. Cheers.